Okay, well, thanks, Richard. Well, my name is Mike Cook. I am an independent health insurance broker based here in Alexandria. One area that I've been able to help a lot of clients is a little unknown rule, and it's really specific here to individuals in Virginia. If you are a self-employed individual in Virginia, and self-employed means you have no partners, you have no employees, you can be married, but your spouse can't be on the plan, or can't be involved with the business, you can actually qualify for group health insurance as an employer group. It's a group of one. Doesn't happen in DC, doesn't happen in Maryland, happens in Virginia. And if that is your case and you don't have access to group coverage through your spouse, and you have to buy through the marketplace, and you don't get a subsidy, a lot of ands there, you can probably save 30 to 40% on your health insurance. You get great coverage. You actually get more comprehensive coverage.
Let me know when you see it.
Yep, I see it.
Okay, so well, that's who I am, so it's pretty much obvious. Now, it's interesting how long that address stays the same. We'll wait and see. But really what I wanted to cover today was options that as individuals that we may have to help lower cost or our health insurance costs. The key with health insurance is really knowing what your options are, what you have available to you to make sure you can get the coverage that you want. For those of us who don't have or aren't fortunate enough to have access to a large employer plan, that has limited us in the past to really being going out onto the individual marketplace, either through healthcare.gov or directly to the insurance company to get our health insurance. For those of us who are not eligible for a subsidy to help lower the cost, we're pretty much stuck paying what the insurance companies are going to charge us. And prices on the individual market are exorbitant. They can be extremely expensive for plans. One of the things we are very fortunate of here in Virginia is that Virginia is a state that allows you as a sole proprietor to be able to apply for group coverage. The definition of a sole proprietor can be an S Corp, a C Corp, an LLC, but you are the only worker. You can't have an employee. You can't have a partner. Now you can cover yourself as a family, so you could be the worker and cover your spouse and kids on the plan, but you can't be the worker and have your wife as partner in the business or your husband as a partner in the business. It just has to be you. But if that is the case, you can find substantial savings. This is a great option for people who are realtors. I have a number of realtors who may work for a particular realty office, but they are basically 1099, so they're self-employed individuals, so they could have an LLC or S Corp or C Corp set up, and they can take advantage of this and lower their costs tremendously. What I've done is actually used me as the example. So these are plans that are based off of my personal birth date, and the insurance company we're going to sort of pick on is Care First. And this first one is an individual plan. Now, we don't want to get wrapped up in all the details, but I'm trying to do like plans. But if you look at this plan, you see it's an HSA. It's a high deductible plan. It's got a $3,000 deductible. But when we go down to the bottom, we see that the cost for this plan, for me to buy it, is $1,316.41 a month. That's the plan. That's the cost to buy that plan if I went to healthcare.gov or if I went directly to Care First and I wanted to buy this plan. If I wanted to take a plan and say, well, what could I find as a company, my company of one? I could go over and look at the same type of plan that's got a $3,000 deductible, and now it's a POS plan. It's not a true HMO plan. This plan gives you in-network and out-of-network coverage, but for purposes of comparison, we're going to say everything we do is in-network. I can find almost the exact same plan that costs me $871 a month. And if you just do the math, that's pretty much substantial savings about what we're going to do for the same type of coverage. Now, as an individual business, either one of these plans become business expenses. So you don't have to just have a group plan to be able to treat it as a business expense. But the group plan is billed as a company. It comes to my company's name, and I'm the one that's insured on it. When we look at what we can save per month is substantial. If we say, what happens if I don't want an HMO? What if I want a PPO? The difference between an HMO and a PPO is a plan that really allows you to go to out-of-network doctors. It would also allow you to go to in-network doctors all across the country. You could want to see a doctor out at the UCLA Medical Center. There's a good chance that they're going to be part of the PPO network. Clients that use the PPO plans may be clients that have kids that are going to college outside of the area and want to make sure those kids have access to in-network doctors. An HMO plan would never allow that. But because of that, an HMO plan, the prices are pretty high. So here we have a PPO plan that has a $1,750 deductible. Max out-of-pocket is $6,650. That's where this number is right here. And the premium, just for me by myself, $2,886.13. That's a mortgage, but that's what that would cost me for health insurance if I were to buy this as an individual plan. It does give me out-of-network coverage. At the same time, if I were to look at the same type of plan as a group plan, here's a group plan that has a $1,500 deductible. It's actually smaller than the other plan, smaller than the other deductible. It has a max out-of-pocket of $3,900, which is like half of what the other one had. And we're looking at a cost of $1,212. So once again, you can see where going into the group option can just substantially save you a large amount of money. And people say, well, why is that? It really has to do with the fact that the way things are pooled. The healthcare law on the individual market basically came out and said, we can no longer discriminate between people who have pre-existing conditions or are totally healthy. And that's the number one reason the price of health insurance has continued to go up. The group market has pretty much always been guaranteed issue. Here in Virginia, they were allowed to adjust the price because of pre-existing conditions, but pretty much if you were on a group plan, you could get the coverage that you wanted regardless of what health conditions you may have. Well, the group business from all insurance companies, and just not Care First, the insurance companies have a pretty good idea on what their claim rates are going to be. And that's why we're seeing a tremendous difference in the price of coverage here. You can see an annual cost of $34,000 compared to an annual cost of $14,000. And again, that's just for me. It's still expensive, but if you needed a PPO plan, you can see what the option is going to be, what option is really better. The biggest question I get is, what is the best policy? And the word best really is it's a pretty open word. Best describes, for me, it could be totally different than the person I could be talking to. Best in many cases for me is what policy is going to allow me to spend the least amount of money. The one thing I know for sure is that the minute I write a check to the insurance company, the money's gone. I don't have access to that money anymore. My belief is I would like to keep as much money in my pocket, knowing what my expenses are, maybe not being comfortable with what I have to spend, but knowing what my expenses are and being able to pay that as opposed to paying a much higher cost to the insurance company every month to cover those plans right from the start. Doesn't matter if it's a PPO plan or an HMO plan. What really matters is how much does the policy pay right from day one. Am I going to be required to pay for it, or is the insurance company going to pay for things? So we can look at a pretty high-level PPO plan. This is an individual plan, has a $500 deductible. What we're looking at here, and this is a group plan. Basically, the first $500 I'm going to owe if I have to go into the hospital. But other than that, this plan pretty much pays from day one anything that I would need to have done. The cost for a plan like this is $1,438, which is still a lot of money. Now, it's not what you would find on the individual market, and realistically, you couldn't even find this plan on the individual market. The price would be so high, the insurance companies, or Care First in this case, doesn't even offer a platinum plan anymore because no one can afford it. But in the group market, if you wanted a PPO plan that sort of paid from day one, every time you go to the doctor, you pay $10, you go to your specialist, you pay $30, this is a pretty benefit-rich plan. As opposed to a plan, or what your expenses would be. What could be, if you had a really bad year, what would you expect to see in a plan like this? Well, you know your deductible's $1,500. We know your max out-of-pocket's, or your deductible's $500. Your max out-of-pocket's $1,500. We know what your monthly cost is. You got to pay the cost of insurance. Well, if you had a really bad year, you paid your insurance all 12 months, you met your deductible, you met your max out of pocket, you would spend $18,756 on your health insurance. So if you had a bill, if you had, God forbid, you had a health insurance charge at a hospital of $100,000, you would be responsible for $18,756 of that cost in a year. That's your premium plus your deductible plus your max out of pocket. How does that compare to the type of plan? This is the type of plan I have. It's called a health savings account, or an HSA. What you see first is that your deductible is a bit higher. Now, $2,000 isn't a lot more than $500, but it's still a little bit more. You can get these deductibles as high as up to $4,000 or $5,000. But what you're required to do with a plan like this is you have to pay everything out of that deductible first. It's something that people generally don't like to do. They want to go down here and go to the primary care doctor. They just want to pay $10. Well, this plan, I'm paying the cost of that doctor's visit out of this deductible of $2,000. After I meet that deductible, then I start paying 30% of the cost of that coverage. And I can continue to pay that until I get to my max out of pocket of $6,750. Now, the money that you pay is always at insurance cost. It's not, if the doctor charges $100 and insurance says, well, you can charge us $100, but the cost for that visit's only, we're going to see the cost of that visit is $42. Well, that's what you're paying. You're paying $42. You're not paying the $100. So you're always paying insurance cost, but you are paying that. So you're pretty much paying the first $2,000 of anything that you do other than preventative. Cost for a plan like this is $986. Now, there are some tax advantages to this plan, which I'll touch on in a second. But if we look at what happens with this plan, if we have a really bad year, we'll take that same $100,000 bad hospital stay. Well, we know we have a monthly cost of $986 we have to pay every month. That works out to be almost $12,000 in premium. We've got a deductible of $2,000 and a max out of pocket of $6,750. That leaves our total exposure of $18,852. If we compare that against what we would consider the plan that gives us the best coverage out there, we actually spend less money. We spend $18,526 compared to the $18,000. I back it up here a second. I can show you what the cost is. To the $18,756. We spend $200 less with a plan that has a deductible that's 4 times as high. So just because you have a low deductible plan doesn't necessarily mean that you have a plan that's going to give you the highest level of coverage. The HSA, and this is what I like about the HSA, it allows us, in addition to, instead of paying that higher premium to the insurance company, we can pay a little bit of money back to ourselves. As an HSA owner, you're allowed to put money into a HSA tax fund. It's a bank account. It's just like a checking account. Not all banks have them, but if you have an HSA account, you could set one of these up. And as an individual, you can put $3,550 into the plan. If you're over 50 or over 55, you can put another $1,000 into it. That money is tax-free. So if you're making $100,000 a year, you can actually take, and you max out your max contribution, you can actually put $4,550 right off of your taxes, right off the top. That money is not a use it or lose it. It can roll over from year to year to year to year. So you can actually start to build up a pretty large sum of money into this HSA account, money that you never ever have to pay taxes on. That money doesn't always have to be used for medical expenses. This is where HSAs are really popular. And a lot of people don't really think about using them other than just medical expenses. Just because you've got $6,000 or $7,000 in your HSA account, you go to the doctor and the doctor bills $100. You can pay out of that HSA account, but you don't have to. You can go ahead and pay the normal medical bill. Just pay it like you normally would. Save that medical receipt. What does that mean? Here's the difference in cost comparisons again between the two plans. But what does that mean when you're looking at an HSA account? We can save our receipts, let your balance grow from year to year to year. I work with clients that will have 70, 80, 90, $100,000 in their HSA accounts that they've had over their entire working career. What you can do, if you are going to retire and not taking Social Security, you can use that money in your HSA account to pay you and not the doctor's office. So you have a bill that's, you had a procedure done that may have cost you a couple $1,000s. Save that medical bill, pay that $2,000 expense just like you normally would, not out of your HSA account. Now you're retired and you're 67 years old and you haven't started taking your Social Security yet. You can now take that $2,000 medical bill, submit it to the HSA account, and they will pay you $2,000. It's your money. You'll get a $2,000 check back. That $2,000 is tax-free. That comes back to you. So now you've actually increased your income. You can use an HRA just like you would use an IRA in retirement. If you take money out of the HSA early, it's just like you take money out of an IRA account early. You do pay a 20% tax penalty in addition to paying income tax. But there's no penalty for non-health care withdrawals through retirement. It works just like an IRA. Individuals, and I would encourage people to talk to their financial planners when they're getting into this, but an HSA can double up what an IRA is doing. There's no minimum distributions. With an IRA, you have to start taking required distributions after age 70 and a half. That's not the case with an HSA. So you can actually save money in there a little bit longer. An HSA, if for some reason you pass away, that money just passes on to your to the beneficiary. It is tax deferred and grows interest, or goes tax-free on the interest as well. Those are probably the biggest advantages when we're looking at group coverage as opposed to individual coverage. But what I would really, have people do when they're looking at their options that they have is to see if they do qualify as a sole proprietor. There are specific things that an insurance company will want to see to make sure that you do meet those qualifications. Feel free to give me a call and I can help you understand what those are. Probably the other great thing about individual or the group coverage is there's no enrollment window. You can apply for a group plan 12 months out of the year. You don't have to have an event happen. It's not like you have an individual plan and the company's going to say, well, let us know what insurance you just lost that allows you to apply for this. With a group plan, if you want coverage to start October 1, we just need to get the application into the insurance company probably by the middle of September and your coverage will start. And that's about it.
Mike, this is great. A quick question is, you were talking about the your health insurance, if you're in a group plan, is for your business is going to be tax deductible anyway. So then that's for your premiums. But
Yeah.
So you're saying then the health savings account gives you that added
Right.
You're putting money in. Okay.
Yeah, but if you have a health savings account, well, we'll think of it on two things. One, think of it as a big business. You're working for IBM, and you pick their HSA option. Many times, what a business will do, they'll come back to you and they'll say, well, Fraser, yeah, we know you had this great plan that had a $1,000 deductible, but we're actually trying to save some money. So we started this HSA, and this is going to have a $3,000 deductible. But what we're going to do to make it easy for you, we're going to fund that HSA for $2,000. So now you still have a $1,000 deductible. So they sort of get you started on the HSA side. As an individual, as a sole proprietor, you have the ability, if you want your business to fund part of the HSA, it can do that. It's a business expense, but there's not that big a benefit for it because as an individual, all the money comes back to you anyway. You are the business. So in my particular case, my company pays 100% of my premium, but I have my HSA account set up to my personal bank account, and I just contribute money out of that. And then at the end of every year, I get a nice statement from the bank that says, okay, Mike, you've contributed, $4,000 to your HSA. I give that to my tax guy, and he does whatever he does to make sure I get credit for it.
Gotcha. And then the other question, you're talking about this being tax deferred, or I guess tax free. Is the HSA like an IRA where it's invested in, stocks or invested?
Yeah, well, you can. You really can. Now, when you first started out, I mean, like Bank of America has HSA accounts. Not all banks. Like I know John Marshall Bank doesn't have HSA accounts. I wish they did, but they don't. But I have mine set up with an online bank through that I started years ago that's tied to John Marshall. Once you get to a certain amount, you can keep it, it's just like a checking account. You pay a little business service fee. Once you get a little over that, they stop paying the service fee because they're making enough interest off of it. But once you get to a certain amount, you can take that money and invest it in Vanguard. My bank allows you to invest it into a Vanguard account. And they have a little management fee that you charge them. But yeah, you can do just about anything you want to with it.
Well, this is fantastic. So last question I have is just, you said that there are some requirements as sole proprietors in order to qualify for the group plans. Can you just give, top level? Obviously, people need to contact you or should contact you to clarify.
What the insurance companies they're going to want to know that you're a real business. Now, if you were, if you're a business and you had employees, what they look for here in Virginia is the VEC, the Virginia Employment Commission, the tax form that has your employees listed on it with their social security number and the taxes that you've paid. Now, I'm personally an S Corp. I write myself a salary every month, so I actually have a VEC. But as a sole proprietor, if you're not paying yourself a salary, what the insurance companies are going to look for would be your tax filing. Either if you're an S corporation, you can show your personal taxes because all your money from your business goes through your personal taxes. And you can have a business. I know where did I say the business has to make money. I just said you have to have a business, but that would go through onto your personal taxes. So for an S corp, you could show your 1040. For LLCs, for LLCs or C corps, you could show your K1, your K1, your K1, and your schedule. Is it Schedule C?
I think so.
Yeah, Schedule C. That would show that you actually have a business listed. Those are the things that most insurance companies are looking for. In some cases, if a company has started in 2020, let's say the company actually started this year, so they've never had a tax filing for 2019, the insurance companies will take your corporate filing papers that you filed with the state that says, okay, Mike, this is the name of your business. Here's your EIN. That's when everything gets started. So we send the incorporation papers in. Sometimes we'll send a notarized letter in from like a CPA that says, okay, this is to just let you know that, the insurance benefits and resource group started in 2020 and Mike Cook's the only employee. And they will take that as proof that the business has started up. And then we usually put on that letter, we can supply tax records if required to after they're filed. But the key part here is just getting in the game. Once you're there, they're not going to come back and ask for the tax records. But you just have to be able to show something that you're a true business.
This is great, Mike. I mean, I thank you so much for doing this, and I will make sure that your contact information is displayed here as well. I encourage anybody who's watching this to reach out to Mike. Mike has been incredibly helpful and knowledgeable, and he shares this gold as if it's water. And so definitely reach out to him and overwhelm him a little bit more.
Okay, Frazier. Well, thanks.
Thanks, Mike.
Okay, we'll see you Friday. Take care.
Bye.
Bye-bye.